Frequency Podcast Network. Stories that matter, podcasts that resonate.
From the lows of the past week to the highs, trying to forecast what's next in this economy. Hello, my name is Mike Eppel. This past week was hectic, to say the least, starting with the very real expectation that the Trump administration was going to hammer the Canadian economy with 25% export tariffs, only to be avoided temporarily with an 11th hour agreement between Washington and Ottawa to work on measures to fortify the border, while U.S. President Donald Trump was subsequently then shifting the negotiations away from border security and now toward economic targets. Markets initially sold off to start the week, only to then subsequently rebound with the 30-day negotiating window. But as it turned out, our economy wasn't doing too badly at all to start the year, with strong trade statistics and a labor market that created more than 75,000 jobs for the month of January. To try to make sense of it all, I'm joined today by Pedro Antunes, the chief economist at the Conference Board of Canada. Thank you for joining us.
You're welcome. It's a pleasure.
How busy was your week trying to adjust and forecast what we saw at the start, that being on Monday, there was the expectation we were going to be hit with these tariffs starting Tuesday. That didn't transpire. And then at the end of the week, we're capping it off with really strong numbers out of the job market. From an economist standpoint, how do you deal with all of the uncertainty, the unknowns, and then trying to adjust and try to make forecasts?
Well, it's been very busy. In fact, since last Friday, I would say we were, at one point thinking that there was going to be tariffs, and then they were going to be held off all in the middle of, within a 2-hour span. And then, of course, we heard the news that they were coming on the weekend. So, yes, we've been scrambling now, trying to get a sense of, whether these tariffs are actually a strategy here at negotiating, or whether we're actually going to see a policy where we're applying these kinds of very damaging tariffs, not only to Canada, but to the U.S. as well. So far, it's been a lot of thinking about this. We have put a forecast out that does not include these tariffs, but we're looking, and in fact, we're going to be publishing soon some numbers around the implications of a short duration tariff, which I think is the most likely scenario, because these things really are very, very damaging, both to the U.S. and to Canada. But, we saw the reaction from stock markets. I do believe President Trump keeps an eye on the stock market as a gauge of tensions, and he wouldn't want to see that kind of reaction on the U.S. side of things.
How much of a wake-up call, though, has it been? And you see the commentary now coming from various political leaders of all stripes across the country. Oh, we should reduce our interprovincial trade rules and regulations and look for other markets out of the United States. I mean, you can argue these things should have been done a long time ago, but now we're in this scramble phase that, do you expect that this will actually lead to some sort of reworking of trade policy just within our own borders?
I would say shame on us, because these have been issues that have been long-standing, and we've done nothing really to address them, especially with respect to interprovincial trade barriers. I know that we have a Canada Free Trade Agreement, and we're trying to work through regulation by regulation to get essentially open up our internal market. It's really been an embarrassment. Our confederation is sometimes tough, to deal with. The other piece I would say is, pipelines. We're talking now about pipelines, but, we dismissed the Energy East pipeline. Now we're very reliant. I mean, we're talking about countermeasures possibly to cut off the U.S. from energy. Imagine the U.S. could cut us off from gasoline if we didn't have that, that essentially the Line 5 pipeline bringing oil to our Canadian refineries. So it's been, a situation that's longstanding. I'm hopeful that this will finally force some change. There are ways to get around all of the regulations. There's things like that have been applied in Australia, for example, which are mutual recognition agreements, which just essentially say, well, whatever somebody else has put into regulations in the other provinces, that's good enough for us. So we don't have to align on everything. We can just open up the barriers and away we go. So, I do think we're going to see some change. It's going to be also very market driven, because when we think of our resource sector now, the sense that we're so dependent on one market, I do think we're going to see business as a whole look for other opportunities here.
How quickly, though, can things be implemented? Can trade policy be adjusted in short order? You're talking about the pipelines and the pipeline idea east to west as opposed to north to south. I'm hearing a lot of politicians, shall we say, who were previously against that idea, all of a sudden now kind of getting religion and saying, oh, we do need more, supply streams across the country as opposed to relying so much on the United States market.
Yeah, let me just highlight a bit more on that topic. Yeah, so we have essentially Alberta oil, which is a heavy oil, and it is, we don't refine that oil. We ship that south to the Gulf, and the Gulf states have refineries that are tuned to heavy oil, so they absolutely need that heavy oil, what Western Canada Select from Alberta, and there's really no other way to go at this point and to change that quickly. Still, we could have done better with an Energy East pipeline, where we could have gotten conventional oil from Alberta and Saskatchewan and other areas into our refineries. Instead, now we're essentially bringing that oil through the U.S., or in fact bringing oil that's produced in the U.S. Into our refineries that are tuned to essentially lighter oil. So it's a real problem, and we're very dependent, and that's going to be hard to change overnight. The other thing that's going to be very difficult to change is anything to do with our extremely integrated manufacturing sector. It's not just us in the U.S., it's us and North America. So Mexico plays a role in that, with the more labor-intensive tasks being taken up in that economy. And that is impossible to change quickly. And I think if we do, this is why I'm so doubtful, because if we do see tariffs like this would just hurt the U.S. It would hurt their competitiveness. It would raise prices on vehicle manufacturing. And it would just be it's just a mistake all around. So this is why I'm skeptical about it. But of course, if it did happen, it would be devastating for manufacturing. And if it may very well happen, not broad-based, but in certain segments of our manufacturing, who knows? On the other resources, I do think that we're essentially selling our resources at global prices, very competitive markets, and most of our exports to the U.S. right now are resources, and I'd say close to half, if not around about half of those. We're globally competitive. We can move that, especially the stuff that gets to Tidewater. We can move that to other parts of the world. I would just, if I have another minute here, I would just reflect on what happened when China essentially put trade restrictions on canola. If you might remember, that really hit us hard one year. But then in the following year, we essentially found out the markets for our oil and our oil seed, I should say, canola, and prices recovered, and our exports did as well. So this is a similar picture. If we do get these restrictions, we're going to find other markets, and the pain is going to be felt for some of these goods more so in the U.S. than for us.
Do you think the message, though, is getting through? We've got a lot of trade delegations now going to Washington. There are individual states, governors, who are, and the auto industry specifically. Are they getting the message to the U.S. president that you cannot, if you can slap tariffs on, sure, but unwinding the integrated nature of North American trade, you can't just do that overnight. You'll literally be effectively hammering an industry for what? How many years would it take to close plants, wind things down, shift things to the United States? I mean, it's not something you just do within a couple of weeks or months. It takes years.
Yeah, no, exactly. When we think of an auto manufacturing plant, it's billions of dollars, and it takes a lot of time to reestablish essentially manufacturing capacity that we have here in Canada and anywhere else. If we talk about Mexico in that supply chain, there's labor-intensive tasks that would be very, very expensive to do north of the Mexican border, let's say, whether it be in the United States or in Canada. So no, the reason we've opened up trade is because it's a win-win picture for those countries that open up trade barriers. We know, and economists have long seen this, not only in theory, but time and time again in historical examples, where opening up trade barriers is a win-win, especially longer term, and removing those is a lose-lose. President Trump doesn't always see it that way. He does feel that it's a zero-sum game, and if somehow Canada is benefiting from trade with the U.S. or Mexico, and if we have some this trade surplus, this some sort of subsidy. That is absolutely false. Again, I go back to the point that the reason the U.S. has a trade deficit with Canada is because they're buying our high quality resource products at a global price. In fact, at a discounted price. If you talk about some of the products like Western Canada Select or forestry products. So it's just bad policy, and this is coming back to that point that I just don't see it happening in any sustained way because it would be very devastating.
I wanted to talk about some of the specific economic data points that we got this week. The trade statistics for December were much above expectations for exports. A lot of Canadian exports going into the United States. The January jobs report was very strong, 76,000 jobs, unemployment rate coming down. All the talk was about what was the Trump administration going to do? There was this overhang, this cloud. Was that an indication that American buyers were front-loading what they needed, perhaps, in anticipation of trade risks, and also Canadian manufacturers getting ahead of the curve, doing hiring now, and then waiting to see exactly how things worked out on the trade front?
Yeah, well, I think definitely the trade and the strength of exports in December, that definitely was essentially getting ahead of the tariffs. And I think essentially we drained inventories, shipped product across borders as much as possible. And we saw, in fact, our trade surplus improve with the U.S. in that month. That's going to be temporary. Of course, even if tariffs don't get applied, there's going to be now a backlog where you need to actually increase your production to catch up with that. So there may be something related to that where, all of a sudden, if we don't see tariffs, or I don't think markets believe that tariffs are going to be applied for any length of time, because we're not seeing a reaction in equity markets, in stock markets, or in the value of our currency, which if we did see a 25% tariff, I think our currency would fall to 60 cents. So markets really don't believe it. And I think this is what we're seeing in the employment data, perhaps trying to catch up. And essentially because of that diminished inventory, see a rebound in perhaps production. It's hard to say on that. I do know that the December manufacturing data does play out. We did hear from manufacturers about the demand for getting product through the border. The employment data, when we look at the January numbers, manufacturing very strong. The other piece that's really strong in January, and I think we should always focus on this. We always talk about manufacturing jobs as being good jobs. But where Canada has had immense success has been in professional, scientific, technical services. And we saw another very strong month in January on those numbers. Guess what? The depreciated currency, we have seen some depreciation of currency associated with these threats and these scare tactics. That makes us very competitive on these professional, scientific, technical services. When we look at exports of services, which seemingly President Trump isn't focused on at all, he wants the manufacturing jobs. But on exports of services, we've been doing very well, and that's a segment that is continuing to grow in Canada. And I think this is our knowledge, our reality. We're a services economy. We're a knowledge economy. We have a very strong, educated workforce, and it's been phenomenal. I'll just quote you one more number. Since about 2015, we've seen about 4% growth in professional, scientific, technical services employment. That compares to about 1% growth in the rest of the private sector, business sector. I'm excluding anything public in those numbers. So let's focus on our winners. This is where we're doing well, and that's great news that we saw in the January numbers.
Going forward, what do you think the Bank of Canada is going to do with policy at the start of this week? We did see the dollar crater, the bond yields tumbled because at that time there were the tariffs were happening. Then they weren't, and everything kind of cooled down or eased off at the end of the week. And at the end of the day, now there seems to be a recalculation about what the Bank of Canada might be doing with interest rates in early March.
It's a real question mark. I think there's a lot of questions and a lot of scratching heads that we're probably seeing in the central banks. On the one hand, we know that, essentially there's business investment, consumer sentiment, business sentiment. They're all very, very weak. It's really concerning. In fact, when we look at our own index of business confidence, it's almost at recession levels. When we think about the economy on the investment side, on essentially new capacity in machinery and equipment or construction, we're just not seeing the intentions there. The bank would probably have a sense that they could lower rates without causing too much surge in activity in those sectors that are affected by that. That is construction, borrowing for investment, or borrowing by households for new construction or consumption, I guess you could argue as well. I think the bottom line is that we're almost there. Like the bank rate now, or the overnight lending rates at 3%. The Bank of Canada keeps telling us that the neutral rate may be 250, maybe 275. We're not quite sure where they're going to land. There's not a lot more room to maneuver on the downside. I was thinking that the bank would be a little concerned about the value of the dollar. A weak dollar can be inflationary. It doesn't hit us right away, but as we start bringing in consumer goods that are more expensive, we're purchasing them with a weaker dollar. That's what the result of that is. That might be a bit of a concern. And the fact that the Fed is not looking to move as quickly, in other words, interest rates in the U.S. aren't coming down as quickly, that tends to pressure our dollar down. So we may get a pause, we may get another increase, but I say, it's another 25 basis points here or there. We're going to see us getting down to maybe 250. If there are no tariffs and no major recession, I think this is where the bank will land. Not much room left to go.
I'll leave it there at the end of a busy week. Thank you very much for joining us, Pedro Antunes.
It's been a pleasure. Thanks for having me.
That was Pedro Antunes, the Chief Economist at the Conference Board of Canada. My name is Mike Eppel. If you have any questions or story ideas for In This Economy or the Big Story Podcast, you can email me at mike.eppel, that's EPPEL, @rci.rogers.com. Thanks for listening.